Thursday, August 27th, 2020, Maneco 64, home of alternative economics and contrarian views. Many of you have asked me to talk a little more about bonds, and that's good because I have spoken about bonds many times in the past. I worked in the bond markets for over 20 years in the city of London, and I have the experience in the bond market. But today as well, I'd like to show you how bonds are so important to this everything bubble that we have, not only in the bond market, but in the stock market and real estate and other assets out there. The bond market is a mechanism for the central banks to inject liquidity and credit into the system. That's how they do it. And you will see through my presentation how important and how big the bond market is. This presentation, by the way, I prepared that for earlier this year. I was going to go to Holland to give a presentation about the bond market. Unfortunately, the crisis canceled everything, but I've updated a little bit. There's really not much to update in terms of the fundamentals of the bond market, but I've had to update the bank's balance sheets. As we know, they've gone through the roof this year. So let's start. After I finish talking about bonds, we'll quickly look at where the markets are. So let's start looking at bonds. So we're going to look at what they are, how the bond markets work, and how the central banks have hijacked the bond markets. And yeah, I put a little note at the bottom there. It says AKA, also known as fixed income market, but I would say now it's fixed income confiscation because of the negative rates that people get, or yields as well, when they buy the bonds, and also the real negative returns they get because of the rising cost of living. If you deduct that for the coupon that you get, which is minimal these days, you don't really get an income. Bonds are basically loans from investors or savers to borrowers. So it's a loan. Unlike loans, though, bonds are securitized and issued into the financial markets. So who are the borrowers in the bond markets? Well, you've got governments, municipalities, international organizations, corporations, agencies. You've got mortgage bonds. You've got money market CDs, right? These are corporations as well. They borrow money through the money markets. There's two kinds of markets. There's the primary market versus the secondary market. The primary market is when a company or any of those borrowers issue a new loan. And usually it's the investment banks that act as agents for the borrowers. So now you can understand why the investment banks have done so well from this crisis, with all the debt that's been issued by the government and even by corporations now, because interest rates are so low. Why interest rates have been driven so low? Well, because the central banks are buying all the bonds, right? So that's the primary market, and that's where the JP Morgans, Goldman Sachs's, and all the other big banks of the world make their billions. They act as agents for the borrowers, and they don't even lend them money. They just like turn it around. They buy it for 100 and sell it for 100.02. It might sound very little, but when you're talking trillions, it adds up, right? So where are bonds traded? Well, bonds are traded mostly over the counter through dealers and brokers, not on exchanges like stocks. Bonds have been packaged into ETFs as well, funds, and they can also be traded on exchanges though, but I would say the majority of bonds are traded through the dealers, through the banks, through the brokers. There's also inter-dealer brokers as well. So the derivatives market for bonds is huge. You've got the OTC market, where clients call the dealers, maybe at Goldman Sachs or Merrill Lynch or Bank of America, Merrill Lynch, or JP Morgan, and they ask the banker to write up a derivative contract, much like in The Big Short. the fund manager went around New York, Wall Street, asking for different contracts on the subprime mortgage. And then you've got exchange traded. They're uniform contracts traded publicly on exchanges like the CME. You've got the 10-year note future. You've got Fed funds futures and others. How big is the bond market relative to equity or stock markets? And that's where most people will be surprised. We've got here capital markets fact sheets. Equity markets in 2018 were worth about 75 trillion. Bond markets were worth about 102.8 trillion. So it's much bigger than the equity market, the bond market. That's where the money flows into the equity market from all the lending, all the credit created through the bond market. Where do you think the corporations that have been doing corporate buybacks of their stock, where do you think they're getting the money to buy their stock? Well, they're issuing corporate bonds at very low rates, almost for free, and taking the proceeds of those issues of bonds. The proceeds, of course, is cash. So they take that cash and buy the stock. So that's how important the bond market is, not only for interest rates, but the stock market. So this here on the right gives you an idea how big the bond market or interest rate derivatives are. So there you go. It's the blue bar. You can see how foreign exchange, equities, commodities, and credit derivatives are so much tinier than the bond market. So that's how big they are. So here we've got a summary of debt securities outstanding by residents and sector of issuer, amounts outstanding in billions of dollars. It's from the BIS. You can see how big the bond market is. In France, it's almost 5 trillion. As per the second quarter of last year, look at the United States, 40 trillion, Japan, 12 trillion, United Kingdom, almost 6 trillion at 5.8. So now the mechanics of bonds. A lot of people get confused when people talk about bonds, that the yields dropped. They think that that's a bad thing. It's something dropping, but it's actually a good thing for the price of bonds. So let's go through this. So the most important one, I would say, is the inverse relationship between price and yields. Bonds issued at par or 100 in the primary market with a coupon interest rates that pays an income. So when the bond is issued at first in the primary market, let's say IBM issues a bond in the market and borrows $2 billion, and it issues the bond at par at 100, and the coupon is 6%. I'm sure it's a lot lower now, but let's use 6%. So that's the coupon. That's not the yield. But if investors were to buy or sell the IBM bond, the yield would be different than the 6% coupon. But if the price doesn't move, it stays at par, the yield will be 6%. And the coupon will also be 6%, right? Coupon rate multiplied by the principal, par value or face value of the bond provides the dollar amount of the coupon payment. So yeah, you're gonna get $6 every year. Of course, the yield might be different. You might have had to pay more for the bond or less. So what is usually the duration or the term of a bond? Well, bonds are issued for a certain period of time or term, from 1 year all the way to 100 years. I think Austria issued 100-year bonds recently, even Argentina, believe it or not. And usually less than a year, they're called bills, and they're usually issued on a discounted basis. So let's say you buy a bill at 98, and then at the end of 1 month, 3 months, 6 months, or 1 year, you'll get the 100 back. That's what it means. There are other kinds of bonds, different bonds. They're convertible bonds. You can convert them into equity sometimes. They're callable bonds. That means that the issuer can pay back the bond before the term ends. Usually they do that when interest rates are going lower, so they can lower their cost of borrowing. They'll buy back the old bonds, call them back, and then issue at a lower rate. That hurts investors, of course, because they're going to be getting a lower yield. So there's floating rate bonds and fixed rate bonds. Most bonds are fixed rates. Floating rates, they just move with interest rates. They're set every 6 months or so. So when yields are going down, that's not good for investors to buy floating rate bonds. It's a good bond to have in the market that where yields are going up in a bear market for bonds. So that's probably why they're not very common anymore, because we've had a bull market in bonds for so long. So this is the interesting part here about risks affecting bond prices. I would say now the top risk, and this wouldn't be in a textbook 15, 20 years ago. So you've got central bank buying, or QE. I think that affects bond prices now greatly. You got credit or default risk. That's a simple one. It's whether you think the issuer or the borrower has good credit or not, whether it can default. And that's usually why US Treasuries are called risk-free rate of return, because as Alan Greenspan said, the US Treasury can always print the money. But of course, that printed money could become worthless. Market or interest rate risk, well, that's in the secondary market. The price can move. Investors buy and sell bonds, right? Timing or call risk. A call risk is related to whether the bond is callable. Yield curve or maturity risk, well, that is just about how long the bond's been issued for, the term of the bond. The longer the term, the riskier it gets. It's a simple reasoning. If you lend someone money for a longer period of time, there's more risk involved, right? Inflation or purchasing power risk, yeah. I think we've got loads of that right now, even though a lot of people don't think we do. If inflation rises, the coupon becomes diluted, right? If you buy a bond and the yield is 3% and then the rate of inflation goes to 30%, you're going to be losing out massively, or even at 5% inflation. Marketability or liquidity risk, well, that's what we had in March. That's how quickly or how easily can you liquidate, sell those bonds. If the financial sector, the banks are in trouble like they were in March, you will find it very difficult to get a dealer to quote a bid for you so you can hit the bid, sell the bond. So that's very important. Exchange rate or currency risk. Yeah, that's for international investors. That's quite straightforward. And if you buy bonds, if you're an American, you buy a bond denominated in sterling or euro or vice versa. Political or legal risk, of course. Event risk. Well, yeah, event risk. That's we've had plenty of that this year. And sector risk. The airline companies' bonds, they did very badly in the beginning of the crisis, and they're probably not doing very well right now, and that's why the Feds had to intervene, right? That's the sector risk. So this is what the central bankers are doing, and Mario Draghi, he was the president of the ECB during the European sovereign debt crisis, said, within our mandate, the ECB is ready to do whatever it takes to preserve the euro. Believe me, it will be enough. So this is my opinion of what the central banks are doing. But this is not only Mario Draghi now, it's all the central banks. It's creating the biggest bond bubble ever and the biggest everything bubble ever. So this is what happened during the European debt crisis. You can see how interest rates for all the peripheral European countries was trading very low here in relationship to the German government bond. The chart on the left is the spread between these bonds and the German yield, which is the benchmark in Europe, and you can see how those spreads exploded up. And you can see on the right hand side how interest rates went into double digits in those peripheral countries, or the pigs: Portugal, Italy, Ireland, Greece, and Spain. That was the European debt crisis. So Mario Draghi came in and started a huge amount of QE, and that's how he brought everything down, all the yields down and the prices higher. And the ECB has been doing it ever since. So this presentation was done before everything hit the fan earlier in March this year. You can see the bank's balance sheets here. The total was just around 20 trillion for the major central banks. But I've done an update now, and you can see that we are almost at 27 trillion. So it hasn't ended. They have to keep going. What's the flip side of this? How long can they keep doing this for? Just printing money to buy bonds, to keep interest rates low, to keep funding this whole financial system? Well, as long as people have confidence in all these currencies. And that's why gold and silver are so important indicators of that. A higher gold and silver price is just a barometer of confidence in the central banker's scheme. The other thing that's a little bit more complicated but is very important is convexity. And what is convexity? Well, that's the biggest risk for the global bond markets. You can see by the chart here below, a normal shaped price yield curve such as the one given below suggests that a bond's price may not increase by the same absolute amount when interest rates fall by a certain percentage as when prices decrease due to an interest rate rise by the same percentage. That is because of the curvature or convexity of the yield curve. So yeah, it is a little complicated. All I'm trying to say here is that the longer term bonds, like 10, 20, 30 years, with the lower yields, their prices go up very sharply. So let's say you buy a 1-year bill, the price won't move very much. So that price over that year won't move that much. There's not much risk. But when you buy a 50-year bond, a 100-year bond, if interest rates change just a little bit higher, the price will really move. So yes, it's been a bonanza. The lowering of yields and the dropping yields and even negative yields, it's given speculators and investors a huge capital gain in bonds. But the flip side of that is if rates start moving up just a little bit, those prices could collapse. And that's the biggest risk. It's convexity, you see. Don't worry about convexity if you don't understand. All you need to know is that the unwinding of this bubble could be very severe, and it could blow up very quickly. And that's why I think we saw what we saw in March, as you can see here, with yields spiking, with prices dropping of the 10-year treasury, which is supposed to be the risk-free. And that was when the stock markets were collapsing, right? So that's why they had to intervene. I think the everything bubble was going in March. So hopefully that helps you understand a little more about the bond market. Please comment below in the comment section. I'll try to answer as many questions as possible. I would say that for a lot of my viewers, I see that you have questions in the comment section, but it gets harder and harder for me to answer all of them because I'm getting more and more participation, more and more feedback, more views. So I recommend that you watch my live streams, and you can ask me then. It's every Sunday at 4 p.m. Eastern Time, New York time, or 9 p.m. London time. So with that, let's quickly see where the markets are this morning. What time is it? It's 8:20 a.m. London time. Quickly go through things here. Yesterday was a very interesting day for gold and silver. I thought the price action was very positive for the longer term. We're still not out of the consolidation, but the fact that the gold and silver market rebounded sharply from the lows during US hours is very unusual, I thought. So yeah, right now we're at 1940 in gold, down about $13. Yeah, we're down, but yesterday we got down to 1902. So compared to where we were yesterday, we're a lot higher. The high has been 1960 overnight and the low 1936. Silver led the way, I thought, yesterday when we rose. Right now it's down 25 cents at 27.23. Range has been 27.57 to 26.90. The Dow future is down about 33 points. S&P down 1 3/4. The Nasdaq is up a couple of points. So the stock markets are very quiet this morning. Currencies as well are not moving around that much. Oil is still fairly firm. WTI is at 43.40, unchanged. And just to finish off with a 10-year yield. So now you understand why the yield staying low is so important. It keeps funding this whole bubble, right? And with the convexity, of course, if yields start moving higher, we could see prices of long-term bonds drop very quickly. So the 10-year yield is unchanged. It's just below 70 basis points. It's at 0.685. So there you go. I hope you enjoyed the presentation about bonds. And if you did, I'll probably talk again about bonds because there's a lot more to talk about. So there you go. If you enjoyed this video, make sure you hit the like button. It helps with the algorithms, I guess. Share it far and wide as well. And also think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great rest of the day. Take care. Bye.